This Tuesday, March 17th, the ZEW Economic Sentiment Index for Germany came in at negative 0.5. The consensus forecast was 39. The lowest estimate from any economist anywhere on Earth was 30. The actual number missed even the worst-case scenario by 30 points. If you hold European equities right now, this number just repriced your exposure overnight. A drop of 58.8 points in a single month, the third largest collapse in the indicator, is entire 35-year history. Bigger than the crash after American tariffs landed in April of 2025. Smaller only than the 93-point drop after Russia invaded Ukraine in March of 2022. The ZEW president, Professor Achim Wambach, delivered the autopsy in one sentence. The ZEW indicator has collapsed. 80% of the analysts surveyed now expect inflation to accelerate across both Germany and the Eurozone. Inflation expectations surged nearly 79 points in a single reading. Every single sector reversed violently. Chemicals and pharmaceuticals fell 43 points. Automotive dropped 34. Mechanical engineering lost 35. Steel, metals, and construction all cratered. If your pension fund holds Eurozone industrials, every one of those sectors just dragged it down. Construction sentiment was hit twice, once by rising energy costs and again by expectations that interest rates would now go up instead of down. That means every building project in the pipeline just got more expensive, and if you are waiting on a home in Germany, your timeline just got longer. The Eurozone-wide ZEW plunged to negative 8.5 from 39.4, a 47-point swing into its first negative reading in nearly a year. Oxford Economics published its assessment the same day. This will jeopardize the gradual recovery we had been expecting this year. To understand the scale of what just happened, you need to know where that number was less than 2 months ago. In January of 2026, the same ZEW index stood at 59.6, a 4-year high, the strongest reading since July of 2021. The optimism had a reason. The previous March, Germany had done something it had not done in 80 years. It ripped up its own constitution. The Bundestag voted by a 2/3 supermajority to suspend the Schuldenbremse, the debt brake, a rule written into the basic law specifically to prevent the federal government from borrowing beyond 0.35% of GDP. They created a €500 billion off-budget infrastructure fund, the single largest fiscal expansion in Germany's post-war history. $300 billion for federal projects, $100 billion for the 16 states, $100 billion earmarked for climate transformation. They freed all defense spending above 1% of GDP from borrowing limits entirely. They gave the states permission to take on new debt for the first time in a generation. By January, that bet was starting to pay off. Steel and metal sentiment jumped 18 points in a single month. Mechanical engineering climbed 22. Automotive rose 16. The chemical industry gained 12. The Mercosur trade agreement had just been finalized, opening new export channels to South America. Order intake in the final months of 2025 had been stronger than anyone expected. For the first time since the pandemic, a clear majority of financial analysts believed Germany was about to grow again. Your retirement portfolio was being repriced around that assumption. Your mortgage rate was being calculated on that expectation. If you own property in Europe, the value of that investment was anchored to this confidence. Every institutional investor with exposure to European equities adjusted their models around a single idea. Germany is coming back. That was 8 weeks before Tuesday, S number, from 59.6 to negative 0.5, not in a year, not in a quarter, in 30 days. And the thing that erased it was not a banking crisis, not a trade war, not a pandemic. It was an energy shock, the same thing that has broken Germany every single time, the same thing that no amount of money has ever been able to fix. On February 28th, the United States and Israel launched coordinated airstrikes on Iran. The supreme leader was killed on the first night. Within 72 hours, the Islamic Revolutionary Guard Corps declared the Strait of Hormuz closed to all international shipping. Tanker traffic through the waterway, which normally carries roughly 13 million barrels of crude oil per day, about 31% of all seaborne crude flows on Earth, dropped to effectively zero. More than 20 commercial vessels were attacked in the first 2 weeks. Iran deployed at least a dozen sea mines. War risk insurance was pulled entirely. Every major shipping company, Maersk first among them, suspended all transits. The United States Navy refused repeated requests from the global shipping industry for military escorts, stating the risk of attack was too high. No allied nation committed warships. Saudi Arabia began rerouting oil to its Red Sea port of Yanbu via the East-West pipeline, and the UAE diverted crude through the Abu Dhabi pipeline to Fujairah on the Arabian Sea. But those bypass pipelines can carry 3.5 to 5.5 million barrels per day at maximum capacity. The strait was handling 20 million. The gap is unbridgeable, and Iran is not just blocking the strait. It is attacking the alternatives. Drones struck the UAE, Shah gas field, the world largest ultra-sour gas development, forcing it to suspend operations. A fire broke out in the Fujairah oil industry zone. A drone-related incident near Dubai International Airport, once the world's busiest for international passengers, forced the shutdown of the UAE's entire airspace. 6 vessels were damaged in the Persian Gulf in a single week. The message is clear. There is no safe workaround. The International Energy Agency called it the largest disruption to energy supply in the history of the global oil market. Not in modern history. In all of recorded history, European gas prices moved first and hardest. Europe entered this crisis with its gas storage already dangerously low. Germany's storage sat at just 30% of capacity in early February, compared with over 50% a year earlier. The continent needed massive summer injections just to reach 90% before next winter. There was no buffer. The Dutch TTF benchmark, the reference price that determines what every factory, power plant, and household across the continent pays for gas, had been sitting at roughly 32 euros per megawatt hour at the end of February. On the first trading day after the strait closed, March 2nd, TTF surged 45% in a single session to over 46 euros. Within 1 week, it hit 60. Bloomberg called it the biggest weekly gain since the 2022 energy crisis, more than 60% in 5 trading days. Goldman Sachs modeled what a sustained month-long closure would mean. Their answer was 74 euros per megawatt hour, the exact price level that triggered demand destruction across European industry in 2022, when factories simply powered down because it was cheaper to stop production than to pay for energy. Qatar, which supplies roughly 10% of Europe's liquefied natural gas, paused production entirely after Iranian drone strikes damaged facilities across the Persian Gulf region. The IEA authorized the release of 400 million barrels from emergency reserves, the largest such action in the agency's 50-year existence. Brent crude ignored it. The benchmark crossed $100 a barrel on March 12th and was pushing toward 110 by March 18th after Israeli strikes hit Iranian gas infrastructure. If you are paying for groceries in Europe right now, these numbers will land on your receipt within weeks. Fertilizer moves through that strait. So does ammonia. So do the chemical inputs that European agriculture depends on. This is not just your gas bill getting more expensive. It is the price of feeding your family. German gas stations have already been ordered to limit price hikes to once per day, at noon, with fines of up to 100,000 euros for violations. That tells you how fast prices are moving. The government is already trying to slow down the speedometer because the car is going too fast. And here is the structural truth underneath the headlines. This is the third energy shock to hit Germany in 4 years. Russia invaded Ukraine in 2022, and gas surged from 30 euros to 345 at peak. Tariffs landed in 2025, and supply chains buckled. Now Iran in 2026, and the strait is shut. 3 different geopolitical triggers from 3 different parts of the world. The same result every single time. Germany's answer was supposed to be the fund. 500 billion euros over 12 years. Roughly 42 billion per year, the equivalent of 1% of the country's GDP. The European Commission ran its model and projected that GDP would be 1.25% higher by 2029 and 2.5% higher by 2035, assuming productive investment. Deutsche Bahn alone submitted a request for 148 billion euros just for rail modernization. Highways needed rebuilding. Schools needed digitalization. Hospitals needed renovation. The ambition was enormous, but enormous ambition and enormous spending are not the same thing as execution. The Institute of the German Economy found that a shortage of up to 10,000 civil engineers threatens to bottleneck projects worth 30 billion euros per year. The country's notoriously slow planning and permitting system can take a decade to approve a single highway segment. The SüdLink transmission line, critical for connecting northern wind power to southern industry, will not be finished until at least 2028 because Bavaria insisted it be buried underground at 4 to 10 times the cost of overhead cables. Even if the money flows on schedule, the concrete and steel cannot follow at the same pace, and there is a deeper problem the fund cannot solve. It cannot change the price of energy. And the price of energy is the variable that determines whether German industry survives or dies. The average industrial electricity price in Germany before the Iran shock was roughly 14 cents per kilowatt hour. In the United States, it was 7.5 cents. In China, it was 8. That gap existed after years of grid subsidies, the complete nuclear phase-out, the loss of Russian pipeline gas, and hundreds of billions invested in renewables. The Merz government, as answer, was a subsidized industrial electricity price of 5 cents per kilowatt hour. Sounds transformative until you read the conditions. It covers only 50% of a company's electricity consumption. Companies must reinvest half their savings in decarbonization. The program runs 3 years, from 2026 to 2028, and then expires. Around 2,000 companies qualify across 91 sectors. The EU capped the scheme under state aid rules. Deutsche Bank Research published a single verdict that should be framed in the Chancellery. Short-term relief rather than a cure, and the companies those subsidies were designed to rescue are not waiting around. BASF, the largest chemical producer on Earth, Europe, is industrial crown jewel, closed 11 facilities in Germany and committed 10 billion euros to a new integrated mega plant in Zhanjiang, southern China. Not a partnership, not a pilot, a permanent relocation of productive capacity to a country where energy costs are a fraction of what Germany charges. In the first half of 2024 alone, German companies accounted for 57% of all European foreign direct investment flowing into China. Volkswagen poured $2.5 billion into electric vehicle production in Hefei. Bosch expanded Chinese operations while cutting thousands of German jobs. You cannot pour borrowed money into roads and hospitals fast enough to offset a cost structure that pushes your flagship companies onto a different continent. The fund assumes Germany will still have industry worth serving by the time the concrete dries. That assumption is collapsing in real time. The damage is already measured in jobs. In 2024, major German employers announced more than 60,000 layoffs. Bosch slashed 12,500 positions. ThyssenKrupp eliminated 11,000 steelworkers, 40% of its entire steel division. Volkswagen agreed to cut 35,000 jobs at its core brand. The first time in 87 years, the company considered shutting German plants. Continental, ZF Friedrichshafen, Daimler, Siemens, Deutsche Bahn each announced cuts in the thousands. Manufacturing has been in recession since the start of 2022. 4 consecutive years of industrial contraction. The employer association Gesamtmetall reported that the metal and electrical industries are losing roughly 10,000 jobs every single month. Since 2018, 270,000 positions have vanished from that sector. In the 12 months, ending in the third quarter of 2025, 120,000 industrial jobs were destroyed across Germany. The automotive sector alone lost 49,000 in a single year, 6.3% of its entire workforce. Germany's GDP contracted 0.3% in 2023. It shrank 0.2% in 2024. It managed barely 0.2% growth in 2025. 3 consecutive years at or below zero, the worst sustained performance in the country's post-war history. The BDI president, Peter Leibinger, said publicly that this is the deepest crisis in the history of the Federal Republic. He explicitly rejected the claim that it was just a cyclical downturn. This is structural, he said. Germany as a business location is in free fall. And he said that before any of the current numbers came in, and the pipeline of destruction is accelerating. A survey by the Institute of the German Economy, conducted across 2,000 companies in the autumn of 2025, found that 41% of industrial firms are planning still more layoffs in 2026. Only 1 in 7 plans to hire. 33% are cutting investment. 5 consecutive survey periods of negative investment expectations, the worst streak in the Institute's history. IW economist Michael Gromling summarized it without decoration. Job cuts instead of economic recovery. Companies are suffering from major geopolitical stress. Added to this are homegrown location problems, high costs for energy, social security, and bureaucracy. That survey was completed before the Strait of Hormuz closed, before gas prices doubled, before oil broke $100, before the ZEW collapsed. If 41% of industrial companies were planning cuts before the third energy shock in 4 years, the number now is worse. If you work in a factory in Ludwigshafen or Wolfsburg or Stuttgart, your job security is not determined by how good you are at your work. It is determined by whether a shipping lane 8,000 kilometers away stays open, and the one institution that might help is trapped. The European Central Bank meets tomorrow, March 19th, with the deposit rate at 2%, exactly where it has been since last June. 8 rate cuts brought it down from 4% over the previous year. Before the Iran war, the internal debate at the ECB was about cutting further. The February minutes revealed policymakers were genuinely worried about inflation undershooting the 2% target. The euro had strengthened. Staff projections showed headline inflation at 1.9% for 2026, already below target. Traders were pricing in 2 more cuts by year-end. That discussion no longer exists. Energy prices have rewritten the inflation equation in 3 weeks. Gas nearly doubled from pre-war levels. Oil more than doubled. Fertilizer shipments through the strait stopped entirely, meaning food costs are next in line. Bloomberg reported on March 9th that interest rate traders have reversed positions completely, now pricing 2 rate hikes this year instead of cuts. The swap markets flipped. This is a stagflation trap in its purest form. Growth is collapsing and inflation is rising at the same time, driven by the same cause, and there is no monetary policy tool that addresses both simultaneously. Raising rates fights inflation but kills investment. Cutting rates supports borrowing but accelerates the price spiral. Every central banker's nightmare, and it has arrived at the worst possible moment for Europe, its largest economy. Lagarde herself stated publicly that the ECB will do everything necessary to keep inflation under control. But here is the trap for Germany specifically. The 500 billion euro fund is financed entirely through government bonds. Higher interest rates increase the cost of every single euro borrowed. The federal deficit is already projected at 4% of GDP for 2026. Berlin plans to borrow 174 billion euros this year, 3 times the level of 2 years ago, the second highest amount in post-war history. If the ECB raises rates instead of cutting them, the entire fiscal arithmetic changes. The fund was designed for a world where money was cheap and getting cheaper. That world ended on February 28th. Lagarde faces an impossible choice: fight inflation and crush any remaining chance of German recovery, or protect the economy and let prices erode the purchasing power of 350 million Europeans. If you hold euros in a savings account right now, both options cost you money. If you carry a mortgage linked to European rates, one of those options means higher payments starting this summer. There is no path that leads back to where Germany was 8 weeks ago. The window of optimism that opened in January is not just closed. It was never real. It was built on the assumption that the world would cooperate, that energy would flow, that nothing would go wrong in the one area where Germany has no backup plan. 3 crashes in the ZEW. History stand above the rest. March 2022, negative 93.6 after Russia invaded Ukraine and gas prices quintupled. April 2025, negative 65.6 after American tariffs hit and export channels contracted. March 2026, negative 58.8 after the Iran war shut the Strait of Hormuz and energy prices spiked yet again. Every single one was triggered by an energy shock. Every single one hit the same industries: chemicals, steel, automotive, engineering, the sectors that define what Germany is. And after every single shock, the response followed the same formula: borrow more, subsidize more, build more. The Schuldenbremse was suspended. 500 billion euros was allocated. An industrial electricity price was created. Grid fees were slashed. Tax breaks were passed. 10 billion euros in energy subsidies were deployed in 2026 alone. None of it changed the fundamental equation. Germany shut down its last 3 nuclear reactors in April of 2023. It lost its Russian pipeline gas in 2022. It now imports virtually all of its energy, much of it as liquefied natural gas, shipped through exactly the kind of maritime choke points that wars close overnight. Every infrastructure project, every subsidy, every borrowed euro operates on top of a cost structure that a single geopolitical event can double in a week. That is not a business cycle. That is not something a stimulus fixes. That is a structural vulnerability embedded in the foundation of the economy itself. Germany did not just have a bad month. For the 3rd time in 4 years, it proved that its entire economic model depends on a single assumption: that the world's energy will flow freely at prices its industry can afford. And for the 3rd time, that assumption failed. The country that ripped up its constitution, the country that built the most ambitious fiscal package in European history, the country that literally rewrote its laws to borrow €500 billion, just watched a single data release from a research institute in Mannheim confirm that none of it mattered. Not because the money was wasted, not because the politics were wrong, because the problem was never money. It was always energy, and Germany still does not have a plan for that. Now, before we close, I want to connect what we just covered to something concrete. This is not personal financial advice, and it is not a recommendation for any specific action. But the mechanisms in this script have direct implications for how money behaves in this environment, and ignoring that would be dishonest. The first principle is duration exposure. When energy-driven inflation forces central banks to hold rates steady or raise them, long-dated fixed income instruments lose value. This is not opinion, it is bond mathematics. The Bloomberg Global Aggregate Bond Index lost nearly 15% in 2022, the worst year on record for global fixed income, as central banks tightened policy at the fastest pace in decades. The European Central Bank held rates at 2% through 5 consecutive meetings and is now facing pressure to hike again. Shortening duration reduces exposure to exactly this repricing mechanism. The second principle is energy pass-through to consumer prices. Goldman Sachs estimates that a sustained 10% rise in energy prices over 4 quarters reduces GDP by 0.2% in both the Eurozone and the United Kingdom. The current shock has already doubled European gas prices from pre-war levels, far exceeding that threshold. For households holding cash or fixed-rate savings, this means purchasing power erosion that outpaces deposit yields. Inflation-linked instruments have historically preserved real value during supply-driven price spikes, a pattern documented across every major commodity shock since the 1970s. The third principle is geographic diversification of equity exposure. Germany's industrial base is concentrated in energy-intensive sectors that have contracted for 4 consecutive years. The ZEW data confirms that chemicals, automotive, steel, and engineering are the sectors most exposed to every energy shock. Portfolios concentrated in Eurozone industrials have repeatedly underperformed globally diversified benchmarks during each of the 3 energy shocks described in this script. Broadening geographic exposure reduces dependence on any single economy. Structural vulnerabilities. None of these principles require predicting how long the Strait of Hormuz stays closed. They require only recognizing that the mechanism described in this script, energy price transmission into inflation, rates, and industrial output, has now played out 3 times in 4 years. The question worth sitting with is whether your current positioning reflects a world where that keeps happening, or a world where it stops.